So what is the yield curve? So the yield curve is the relationship between the interest rates and the yield and the maturities and the time here. So we have the time to maturity for the same issuer, and then the interest rate that the issuer has to pay. So we have usually the most common type of yield. The yield is usually upward sloping, like in the blue part here, but also we can have instances when the curve is flat or inverted. So the market usually tries to, well, investors, they try to usually forecast what direction the yield curve will have, and then based on the direction, the anticipation whether there will be a recession or not. So at this point here, the lower the inverted yield curve meant at the time that there was an anticipation in the market by an upcoming probably an upcoming recession that will make the interest rates lower in the future than in the short term. So short term rates higher than long term rates. These are annualized rates, no? So it's the same rate per year. So it's the annualized yield on the long-term one was lower than and that's very uncommon. And at that time, the market was anticipating a recession. So it apparently does a pretty decent job in trying to forecast the upcoming recession. So when the yield curve inverts, is more likely that there will be a recession coming in the near future. And we will see now what the yield curve for the US is. We can go to Bloomberg and then look at rates, and we can build here the yield for the US. So we have the annualized return or the annualized yield, and then these are the different debt issued by the US federal government. So we have the different maturities, short term up to a year, then 2, 5, 10, and 30. So we could plot these and then find the yield. So we have positive yields. You can also play with the different other countries like the UK, Germany, Japan, and you will see that Germany, Japan, they have a negative yield curve, and that's yeah, for another video, no? But that's pretty much the yield curve. If you see, the short term is yielding less than the long term, and it seems to be upward sloping. So if you have to build it, it's going to be something like upward sloping like this. For instance, you go to growfocus.com, and then this is the most current one. So you see it's upward sloping. Then a year ago, it had the humped part, or it was, and 2 years ago, it was also upward sloping. So this is the most common, the normal yield curve. And why is it important? Because the inverted curve predicted the past 7 recessions. So it's a pretty good indicator of whether the market is expected to anticipate the recession or not. So that's why you have so many people following it. And also, we can there are some theories that try to explain why the shape of the yield curve is upward sloping. So one of usually the most commonly understood theory is that the yield is higher because your money is tied longer with the issuer, so you have to wait longer. So there's a time premium for holding this. No, so the issuer, we don't know what the future may hold. Therefore, short term should yield less than long term debt, which makes sense. However, there's a theory called the pure expectations theory, or the pure expectations hypothesis, which says that the time premium is flat. So there's no maturity risk premium. The premium for holding long-term securities is 0. And we'll see in the next video what the pure expectations hypothesis is about.